Good afternoon. It's a real pleasure to be with you today and to be given the opportunity for the second year in a row to speak in this very important forum, and especially to share views on where we see the future of private financing for public infrastructure around the world in Natixis, and for us it's a real key element in our strategy moving forward. For that, allow me to go back a little bit in history and describe how we got where we are today. Private financing of infrastructure started 25 years ago in Europe with the financing of landmark projects such as Eurotunnel or Euro Disney, projects that are very well known in this building, which unfortunately failed at various levels, one of which was the lack of common vision between the private sector and the public sector, each wanting to serve its own needs without taking a comprehensive view of the infrastructure projects being financed. Despite these initial setbacks, it forced the industry to rethink the approach in the 90s through the deployment of the PPP model, a powerful recipe to bring together the expertise of the private sector in the development and the financing of public infrastructure. It grew in Europe, but also internationally with European actors, sharing throughout the world the benefit of this model. In this framework, the key features of successful project financing were, firstly, the ability to structure and organize large and complex financing in diverse geographies with equally diverse of local laws and regulations, an expertise that was predominantly gathered in the hands of European banks and their legal advisors. Secondly, an ability to provide long-term financing at reasonable cost. And thirdly, syndication placed amongst banks, mostly European, with a gradual involvement of other regions' banks. By and large, it remained a financing activity led by banks for banks. The 2000 financial crisis, combined with the subsequent sovereign crisis of late 2011, early 2013, changed profoundly and dramatically the landscape. European banks' cost of funds went through the roof at that time. Their ability to raise long-term money shrunk dramatically. This, combined with changes in the regulatory environment, led a number of banks to exit altogether the financing of infrastructure sector. At Natixis, first, infrastructure had been too important to us to think of leaving. And second, we were hit by the crisis far more than other banks and far earlier. And so we had to think how to really continue on our strategy of financing infrastructure. So we used this situation of crisis to invent a new model. We quickly realized that not only banks were challenged by the new financial environment, and some of our key investor clients were also affected in a different manner. After incurring several stresses on their sovereign investment portfolios and looking for diversifying their corporate bonds portfolio, they were searching for other investment avenues. So we have leveraged our long-standing structuring expertise and provide the institutional world with an opportunity to privately finance public infrastructure. Therefore, we created in 2012 a unique infrastructure platform dedicated to form partnership with institutional investors, aimed at offering them the ability to finance the transactions that we were originating. The benefit was multiple. For our issuer clients, we were bringing them larger debt commitments for maturities natively longer than those offered by banks and at an attractive cost. We were providing them with a diversified, attractive, and alternative source of liquidity. For our infrastructure partners, we were bringing them our capacity of origination worldwide that they could not otherwise access, or they would have to build it completely from scratch. So it of course has a cost. Second, over 20 years of international structuring expertise. And third, support in the servicing of these financings. So when we started that in 2012, it was something that was really like a startup. 6 years later, we believe that this trend is here to last. The forthcoming regulatory changes stemming from the Basel Committee, once again, only reinforce our conviction that the future of infrastructure lies in the combination of structuring expertise of experienced players, such as ourselves, and the growing participation of the non-banking financial institution world. Today, based on our expertise, built on 25 years of in-depth knowledge of the industry, and drawn from the 1,100 projects we have financed around the world, we have built Natixis infrastructure platform, the one I've just mentioned, a platform with over 6 billion euros of investment capacity that can offer long-term financing in different currencies. Euro, of course, but also USD, sterling, or even Canadian dollars. We have signed today partnerships with 11 institutions across Europe and several countries in Europe, Asia, and the Middle East. And we are discussing with many more. It's increasing every year. In addition to that, we have launched a new initiative through Ostrom, one of our asset managers, to invest in this asset class. Our aim is to continue growing the universe of institutional investors in order to better connect capital seekers with capital providers. Today, we see three main development avenues in infrastructure financing, and this afternoon panels should discuss them in more detail. First, as already described, financing sources are diversifying and internationalizing, with more institutional players from around the world looking to invest in the infrastructure sector. Second, infrastructure sector and our issuer client needs are becoming more mature. While the infrastructure needs were initially of traditional greenfield project financing, our clients are now looking at acquiring and investing existing operating assets, refinancing their assets using less structured instruments through the bond market, for instance, or monetizing their equity. Natixis' ambition is to leverage our intimate and historical knowledge of this sector and of our client needs to precisely bring them an array of solutions that covers all these needs. We have, for example, been developing advisory services through a dedicated team of infrastructure M&A specialists. This advisory group is leveraging Natixis' international network of M&A boutiques to deliver global sector expertise combined with best-in-class local execution across key infrastructure markets in Europe, the Americas, and Asia. The third element that I think will be discussed this afternoon, and very importantly, is that in a world where social responsibility and sustainability are a growing necessity, the question of sustainable financing, sustainable green especially, becomes a very important element. And there's a lot, there are more and more innovation, financing innovation we need to bring to our issuers, our investors, in order to to answer to this need for sustainable development. We are committed to it in Natixis. We have made our decisions to stop a few years back financing power generation project fueled by coal. We have also expanded our footprint in the structuring and arranging of green financing, and we were very happy to have been named Most Innovative Investment Bank for Climate and Sustainability at the Banker Awards 2018. And for us, our footprint in infrastructure is a very strong rationale and motivation to move in that direction. We have also started a real innovation. I think we are the only bank to do that, and we committed to that in this very room last November. We have introduced the green weighting factor for our financing deals, which means that we take into account the green nature or the brown nature of what we are financing in the RWAs, analytically, of our project, which means that the threshold of profitability for the projects we are financing is lower than if they are contributing to reduce the climate change and the other way around. It is very important for us to have a consistent approach on our different businesses regarding green commitments. As an investment manager, we have been developing approach since many years, especially in Mirova, I'm sure you're familiar with, to systematically assess the environmental and social impacts before investing and monitoring these impacts over time. And we know that infrastructure needs will keep growing. In developed countries, where needs are more and more linked to energy transition, and also in emerging countries, where on top of traditional infrastructure needs, exposure to extreme climatic events advocates for more sustainable projects, and clearly we are committed to accompany these changes. Let me conclude by saying that we are convinced that the private sector remains a key contributor to the growth of the infrastructure industry. We are also convinced that as a bank, if we want to play our role in this sector, it will be based only on our expertise. And that's why we have put in our strategic plan a priority of being one of the most expert banks on 4 sectors. We are focusing on 4 sectors only globally, and infrastructure is one of them. The other one are aviation, energy, and real estate. So we think that by being focused, we'll provide more value to our client. So we therefore look forward to working with you to that extent and to continue to exchange our views to make sure we stay at, I would say, the front line of innovation to continue to accompany you. Thank you very much for your attention.
Thank you, François. Thank you very much.